Hey everyone, and welcome back. We always love to dive into your requests, and we got a really interesting one this time around.
Yeah.
Someone wants to know what this recent election could mean for the economy, but even more so, like what could it mean for their investments?
Yeah, that's a big one.
Yeah,
And
integrated with,
it's kind of a fascinating situation right now, right?
absolutely.
Stock market's going crazy, like record highs after the election. We're talking the S&P 500 just crossed 6,000 for the very first time ever.
Yeah, it's a celebratory mood right now.
It's a big deal. It's like champagne bottles popping everywhere. But then
Yeah.
you have this like this shadow, this like looming thing of the rising national debt. And that's got some people a little on edge.
Yeah, that's the big mystery we're going to be unraveling today is can this market euphoria last, or is it headed for trouble?
Yeah.
Yeah.
Are we going to get a rude awakening? Possibly. And that's what we're going to be looking at today with an article from the Motley Fool. It's called Hold Up. Fed Chair Powell just issued a dour warning on the economy. Is the bull market in trouble?
Okay, so
Oh.
let's unpack this a little bit. Let's start with how the market's actually reacting to the election, because it seems like
Yeah.
overall investors are feeling pretty bullish,
Yeah, they're in here.
particularly about these cyclical stocks.
Yeah.
Those ones that are really tied to how the economy is doing, like financials and energy.
Right, and they're anticipating a surge in economic activity fueled by potential tax cuts, increased business investment, just a brighter economic future is what they're kind of betting on.
Okay.
But the bond market, which is often seen as a little more cautious, reacted differently.
Yeah.
Yields jumped,
Interesting. So it's like,
initially signaling concerns about potential deficit spending and, the specter of inflation.
because we're getting mixed signals here.
Yeah.
On one hand, everybody's celebrating, and on
Mhm.
the other hand, there's this underlying anxiety about
Yeah, like what's this?
what's the price tag of this party going to be?
Exactly. And that's where Fed Chair Powell's warning comes in. And he didn't mince words,
Mhm.
stating that the trajectory of the national debt poses a real threat to the economy,
Oh, and that's not something to take lightly, especially coming from him.
especially coming from him and especially right after a rate cut decision.
Yeah.
So that carries a lot of weight.
Okay, so let's talk about the national debt, because
Yeah.
the Motley Fool article throws around some numbers that are, frankly, a bit mind-boggling.
Yeah.
So back in 1999, the national debt was $5 trillion.
Okay.
Today, it's $35 trillion with a T.
Wow.
That's a seven-fold increase
Yeah, that's incredible.
in just over 2 decades.
Yeah.
And then to make matters even more, interesting, we have this debt to GDP ratio, which compares basically what we owe to what we produce as a country.
Right.
And that has doubled in just one generation.
Hmm.
So our debt burden is twice as heavy compared to what we're producing.
And the article even includes a couple of charts that really bring this to life.
No.
You can really visually see how dramatically the debt has skyrocketed, particularly in the wake of the COVID-19 pandemic and, certain policies of the previous administration.
So this is not some abstract
No,
economic concept.
it's a trend
This is something that could have very real consequences.
with potentially very real consequences. Exactly.
So how much debt is too much debt?
That's the question. Is
Well,
there some sort of line?
Is there a point of no return? Is there how much can an economy handle
Mhm.
before it starts really causing serious problems?
Right. And that's the tricky part. There's no magic number that everyone agrees on.
Okay.
The Motley Fool mentions a Wharton School paper that suggests 200% debt to GDP as a potential limit,
Okay.
but it's not that simple.
Right.
Things like economic growth rates, how independent the central bank is, even the interest rates on the debt all play a role in how much risk a country can handle.
Oh, so there's
And they even draw a comparison to Japan,
Oh, interesting.
which has a massive debt to GDP ratio, but has managed to avoid a major crisis, thanks in part to their unique circumstances, such as a high household savings rate.
So it's like a complex equation. It's not just a pass or fail.
Exactly.
But let's bring it back to you, the listener, because we know you're an informed investor.
Right.
But how do we make sense of this for your portfolio?
Well, in the short term, it appears that investors are laser focused on the potential upside of the election results. They're practically overlooking the debt wings for now.
Oh, so they're just kind of we're going to ride this wave and see where it goes.
Yeah, exactly. But as we discussed, Powell's statement suggests there could be trouble brewing down the line. This isn't, a sky is falling situation, but it's a smart move to be aware of the potential risks.
Okay, so not panicking, but being informed and maybe adjusting our sails a bit.
Exactly.
But before we jump into potential strategies, let's dig a little deeper into what those risks might actually look like if that debt to GDP ratio keeps climbing.
Imagine a scenario where that debt to GDP ratio hits that 200% mark. It's not a pretty picture. We could see a ripple effect of negative consequences.
Like what?
Slower economic growth,
Okay.
businesses hesitant to invest, and interest rates climbing as lenders get nervous.
Oh, so it's like a
And
domino effect.
yeah, exactly. And for you, that could mean your investments delivering lower returns or even losing value.
So essentially the party's over and everyone's left with this massive bar tab.
Right,
But like, what does that actually look like for everyday people?
right.
Like, beyond just investment returns, how would this impact our lives?
So think about it this way. As the government grapples with this massive debt, it might have to cut back on spending in key areas
Okay.
like education infrastructure
Yeah.
or even social programs.
Right. So that means fewer resources for things that are important to you and your community?
Exactly. And as interest rates rise, borrowing for things like homes or cars becomes more expensive.
Oh, wow.
So all of this can put a real strain on household budgets.
Okay, so not exactly the sunny economic outlook that the market seems to be banking on right now.
No, not quite.
But before we all start hoarding canned goods and building bunkers, let's talk solutions.
Okay.
The Motley Fool article mentions diversification as a key strategy.
Yes.
What exactly does that mean in this context?
So diversification is essentially about not putting all your eggs in one basket. If one part of your portfolio takes a hit, other parts can potentially cushion the blow.
Gotcha.
So instead of solely relying on U.S. stocks, which might be particularly vulnerable if the debt situation worsens,
Right.
think about adding some international exposure.
Oh, yeah.
The article specifically mentions the Vanguard FTSE All-World ex-U.S. Index Fund ETF.
That's a mouthful.
It is.
Okay.
But this ETF gives you access to a broad range of companies from developed and emerging markets around the world.
So it's like spreading your bets across different economies.
Right.
Hoping that if one stumbles, the others can pick up the slack.
Exactly.
But for someone who likes to pick individual stocks, are there any international companies that stand out?
The article points to a couple of examples. Philip Morris International, a global tobacco giant,
Okay.
and Mercado Libre, a Latin American e-commerce powerhouse.
Interesting.
These companies operate in different industries and different parts of the world, adding another layer of diversification.
Gotcha. So you're not just diversifying across different economies, you're diversifying across different sectors too.
Exactly.
Okay. And if you're feeling particularly risk averse, the article also suggests looking into safe stocks like utilities.
Yeah, those companies provide essential services like electricity and water,
Okay.
which tend to be more stable even in turbulent economic times.
So we've got international stocks, we've got safe stocks.
Mhm.
Any other tools we can add to our diversification toolkit?
Of course, there's always gold, the classic safe haven asset.
Right.
In times of economic uncertainty, gold tends to hold its value, acting as a sort of insurance policy for your portfolio.
Okay.
The SPDR Gold Shares ETF is a straightforward way to gain exposure to gold without having to buy physical bullion.
Right. So we're essentially building a financial fortress here with multiple layers of protection.
Exactly.
But let's be honest, diversification isn't exactly the most exciting topic in the world.
Right, it's kind of like eating your vegetables, you know? It's good for you, but it's not always the most thrilling part of the meal.
Exactly.
But think of it this way. Diversification isn't about giving up on potential growth. It's about protecting your hard-earned money
Yeah.
and ensuring you're well-positioned for whatever the future holds. It's about navigating that economic ocean with a well-equipped ship ready for both smooth sailing and rough seas.
Love that analogy.
Mm.
So we've talked about diversifying across different stocks and even asset classes.
Mm-hmm.
But what about looking beyond the stock market altogether?
Okay.
Are there other investment avenues worth considering in this environment?
That's a great question. And yes, there are a number of alternative investments that can offer diversification benefits and potentially even act as hedges against inflation.
Okay. Like what?
One option that often comes up is real estate.
Oh, real estate.
It's a tangible asset, like something you can see and touch,
Right.
which can provide a sense of security in uncertain times.
Yeah.
Plus, depending on the market, real estate can generate income through rentals.
So it's like diversifying not just across different types of investments, but also across different forms of value.
Right.
Instead of relying solely on the abstract world of stocks and bonds, we're adding some real world assets to the mix.
Exactly.
But real estate could be a big investment.
Yeah.
Are there any other options for those of us who aren't ready to become landlords?
Absolutely. One alternative that's gaining popularity is investing in collectibles.
Collectibles.
Things like art rare books, vintage cars, even trading cards.
Interesting.
Now, this is definitely a more niche area of investing,
Yeah,
and it requires specialized knowledge and a keen eye for value.
for sure.
But for those who are passionate about these areas, collectibles can offer a unique way to diversify and potentially even profit from market fluctuations.
So like diversifying into passion projects,
Exactly.
investing in things you truly enjoy and understand.
Hmm.
But let's be realistic, not all of us are art connoisseurs or car enthusiasts.
Right.
Are there any other options for those of us who prefer a more hands-off approach to diversification?
Of course, and this might surprise you, but one alternative that's gaining traction is investing in farmland, like
Farmlands.
actual fields and crops.
Wow.
Exactly. It might seem unconventional, but farmland has a number of attractive characteristics as an investment.
Like what?
First, it's a finite resource. They're not making more land,
Right.
which creates inherent value.
Okay.
Second, it's a tangible asset that's essential for food production, making it relatively resilient to economic downturns.
Okay, so people always got to eat.
Exactly. And third, it can generate income through crop yields or land leases.
So it's like diversifying into the very foundation of our food system, investing in something that's literally grounded in the earth.
Exactly.
But I imagine buying a farm isn't exactly accessible to everyone.
Right.
Is there a way to dip your toes into farmland investing without having to trade your city apartment for a tractor?
You're in luck. There are actually a number of platforms emerging that allow individuals to invest in farmland through fractional ownership or crowdfunding models.
Oh, wow.
You can buy shares in a specific farm or a portfolio of farms
Interesting.
and potentially benefit from the appreciation of land value and agricultural income without having to get your hands dirty.
That's fascinating. It's like democratizing access to a asset class that was traditionally reserved for large institutions or wealthy individuals.
Exactly.
So we've gone from international stocks to safe stocks to gold to real estate to collectibles to farmland.
The whole world out there.
It seems like the possibilities for diversification are practically endless.
That's the beauty of investing. There's always something new to learn and explore, and the more you understand the different options available to you, the better equipped you'll be to build a portfolio that aligns with your individual goals and risk tolerance.
So it's not just about finding the right investments. It's about finding the right investments for you.
Exactly.
Investments that fit your unique circumstances and financial personality.
Mm-hmm.
But before we get too carried away with all these diversification options, let's circle back to the original catalyst for this deep dive. The recent election, we've talked about the market's reaction,
Right.
but haven't really dug into the specific policies that the new administration is expected to implement and how those might impact the economy.
That's a key point, and it's where things get really interesting. The election brought a change in leadership, and with it, a new set of priorities and policy proposals.
Okay.
It's essential to analyze these proposals not just through a political lens, but also through an economic one. How might these policies affect economic growth, inflation, interest rates, and ultimately your investments? That's the puzzle we'll be piecing together next.
So stay tuned as we shift gears from broad market trends to specific policy analysis. We'll be dissecting the potential economic implications of the new administration's agenda and exploring how you can position your portfolio to navigate this new political and economic landscape. Okay, so we've talked a lot about the market's reaction to the election and those looming debt concerns.
Right.
But let's actually get down to brass tacks and examine what specific policy changes might be on the horizon.
Okay, so the new administration has been pretty vocal about their agenda focusing heavily on clean energy and infrastructure spending. They've also hinted at potential changes to the tax code, particularly for corporations and high earners.
Right.
These proposals, while aimed at addressing societal needs, could have a ripple effect on the economy and the markets.
Okay, so let's break it down, starting with clean energy.
Okay.
What are the potential investment implications of this major push towards renewables?
Well, the shift towards clean energy is a global megatrend, and this new administration seems poised to accelerate that shift.
Yeah.
This could translate into some significant opportunities for companies involved in solar wind battery technology and even green infrastructure projects.
Right.
We're already seeing a lot of investor interest in this space, and that's likely to intensify.
So for investors looking to capitalize on this trend, are there specific companies or ETFs worth considering?
There are certainly a lot of options out there, but it's important to do your research and understand the different players in the clean energy ecosystem.
Yeah.
Some established players like Tesla and First Solar are already major forces in the market.
Right.
While newer companies are emerging with some innovative technologies, there are also a number of ETFs that provide broad exposure to the clean energy sector, such as the iShares Global Clean Energy ETF, ticker symbol ICLM,
Okay.
or the Invesco Solar ETF, ticker symbol TAN.
Gotcha. Okay, so clean energy seems like a pretty clear potential winner in this scenario.
Yeah.
What about infrastructure spending? Where might we see opportunities there?
Infrastructure is another area where the new administration has signaled a strong commitment.
Okay.
Think roads, bridges, airports,
Well,
broadband, internet, even water systems.
wow. So it's not just about building new things. It's also about upgrading and modernizing what we already have.
Exactly. It's a huge undertaking.
Yeah, it seems like a pretty broad-based opportunity.
Mm-hmm.
But how can investors actually get in on the action?
Well, there are a number of ways to play the infrastructure theme. You could invest in individual companies like Caterpillar or Jacobs Engineering Group,
Okay.
both of which are major players in the construction and engineering space.
Right.
Or you could look at ETFs that focus on infrastructure,
Oh, sure.
such as the Global X U.S. Infrastructure Development ETF, ticker symbol PAVE,
Okay.
or the iShares Global Infrastructure ETF, ticker symbol IGF.
Okay, great. So clean energy and infrastructure seem like potential bright spots.
Yeah.
What about the potential tax changes? How might those impact the market?
Well, tax policy is always a complex and politically charged issue,
It sure is.
and the details of any proposed changes are still uncertain.
Yeah.
However, if the new administration does move forward with plans to raise taxes on corporations and high earners, it could have a mixed impact on the market.
In what way?
Well, on one hand, higher taxes could potentially reduce corporate profits and put downward pressure on stock prices, particularly for companies that are highly sensitive to tax changes. On the other hand, increased tax revenue could also be used to fund those clean energy and infrastructure projects we just talked about,
Right.
which could ultimately boost economic growth and create new investment opportunities.
So it's like this delicate balancing act,
Exactly.
trying to stimulate certain sectors of the economy without putting too much of a burden on others.
Right.
Seems there's a lot of moving pieces and a lot of uncertainty.
Precisely. And that's why it's more important than ever for investors to stay informed.
Yeah.
Do their research, and be prepared to adapt their strategies as the policy landscape evolves.
Okay, so we've covered a lot of ground today, from the market's initial euphoria to the potential policy changes that could shape the economic landscape in the years to come. It's a lot to digest.
Yeah.
What's the key takeaway for our listeners, especially those who might be feeling a little overwhelmed by all this information?
I think the key takeaway is that the market is always forward-looking. It's trying to anticipate what the future holds and price those expectations into. So while the election results and the looming debt concerns are important factors to consider, it's equally important to focus on those long-term trends and the policy changes that could reshape the investment landscape.
So it's not just about reacting to the headlines, it's about understanding those underlying forces that are driving the market.
Exactly.
But as we've discussed, the future is inherently uncertain.
Right.
So how can investors make informed decisions when there are so many variables at play?
That's where the principles of diversification, risk management, and ongoing learning come into play.
Okay.
By spreading your investments across different asset classes, sectors, and even geographies, you can mitigate the risk of any single event or policy change having an outsized impact on your portfolio.
Right, so you're not putting all your eggs in one basket.
Exactly. And by staying informed, you can adapt your strategy as the market evolves and new opportunities emerge.
So it's like we're all on a journey of financial exploration, and the key is to have a good map, a sturdy compass, and a willingness to adjust course as needed.
I like.
But before we end our deep dive today, I want to leave our listeners with one final thought.
Okay.
We've talked a lot about specific investment strategies.
Mm-hmm.
But what's the most important piece of advice you can give to someone who's just starting out on their investment journey?
That's a great question. I think the most important piece of advice I can give is to invest in yourself.
Oh, invest in yourself.
That means educating yourself about financial matters, understanding your own risk tolerance and financial goals, and developing a long-term investment plan that aligns with your values and aspirations.
So it's not just about the numbers, it's about aligning your investments with your overall life goals.
Exactly. Remember, investing is not just about making money, it's about building a future that you're excited about.
Well said, and on that note, we'd like to thank you for joining us on this deep dive into the post-election market landscape. We hope you found it informative and empowering.
As always, it's been a pleasure sharing our insights with you. Remember, the world of investing is constantly evolving, so stay curious, stay informed, and most importantly, enjoy the journey.